Hi, Larry Berman here, and here's what's on my radar this week. Well, no surprise, and it hasn't been different than any other week for months and months and months. And just like that white-winged dove comes in, the Federal Reserve again, transitory in terms of the inflation message. However, they now have set the stage for the taper starting likely in November, likely going a bit faster than the market had been looking for. 15 to 20 billion of taper a month to be done by about mid-2022. So that was the message from the Fed this week, and I thought it was more hawkish than the market expected. A little bit surprised by the reaction post-Fed of a pop in equities. I think that was a little bit more based on some relief that China's not going to blow up the world on credit. Maybe it's a bit of relief that Washington might get their stuff in gear. Their shit in gear. But maybe not. So I don't think we're past the anxiety issues that the markets have had, notwithstanding the decent jump in markets this week. But overall, I think the risk factors in my modeling still remain very high, but we've certainly come off the boil from a couple of weeks ago. So great story, great research paper, white paper that came out of the New York Federal Reserve, Liberty Street Economics. Hit my desk this morning. There's a link that you can have a look at there. We'll probably flash it up on the screen or put it in the notes below. And basically, have consumers changed their expectations for long-run inflation? Has it become unanchored? And as we see in this chart of inflation expectations, this graphic looks at the difference between market-based price inflation expectations 5 years from today for the next 5 years. And what we can see here in the graphic is going back to the early part of the 2000s, long-run inflation expectations were anchored in the 2.5% to 3% range, 3.25% range. And after the great financial crisis and the oil shock of oil prices going from 100 all the way back down, inflation expectations came down a good notch, where they were ranging between, say, 2 and 2.5. And now it looks like we're tacting, we're changing, and inflation expectations are going to head back up to that 3 range. And that would take the market-based pricing multiple down significantly. The market multiple started going up and up and up as future expectation for inflations came down and down and down, interest rates came down. And so this is going to be very much part of the next part of the cycle. Not what was in the rearview mirror, but about the go forward. And what should the market multiple be when inflation expectations are starting to elevate? That's about the future. That's what we're focused on going forward here. Bull and bear pick of the week. So how do you best play the inflation narrative if inflation's going to be a bit more sticky? Commodities are the obvious place. Again, gold. Wow, that it's killing me, because now if the Fed is going to be unwinding and bond yields are going to be going up more than the rate of inflation, then gold should be tanking. But that's not likely what's going to happen. The Fed is going to be very, 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 very slow in raising rates. And so we're going to see inflation pressures remain and inflation pressures higher than the actual nominal yield. And so this is going to be very tricky. It should be bullish for energy markets, it should be bullish for commodities in general, and gold's got to be amongst the cheapest asset class. Got pasted again this week on expectations of the Fed being more hawkish. So the bull pick of the week has to be focused around precious metals and commodities in general. And what are we cautious on? What do we think should be avoided? Growth. For a little while here, as we come to figure out what that growth rate's going to be, again, as we heard from the Fed this week, downgrading the outlook to gold. If you look at the real-time indicators, for growth, and if you look at the real-time indicators, everything we're starting to see is for slower and slower and slower growth. And if we don't get this massive new spending bill, we hit this fiscal cliff. And that just doesn't bode well for anything but a stagflationary type outcome over the next couple of years. Have a great week, everyone.